My name is Michael Duke, and this is the show where I cover stocks that are interesting, and I do so with a tiny mustache. So if you find that interesting, then please consider liking this video and subscribing to the channel. Kind of a shorter update video here for you today. I'm going to be I'm trying to be better about this, revisiting things that I've covered in the past and seeing how we've done. So today I'm going to be talking about Republic Services Inc., ticker RSG. Of course, this is a company that is almost exclusively located in America, performing waste management and collection services. Okay. Um, for a deep dive into what the company does, that's no doubt deeper than what I'm going to talk about today, be sure to check out the other video, the original video that I did about this company, where I go in depth about the company overview and discuss a few things. I, of course, will touch on that today, but this is mainly going to be a video where we revisit how we've done and see if the thesis is still intact. Another thing I want to start off with, we did write an article here that was placed on Seeking Alpha, um, posted here to Tuesday, December 3rd, 2024. The point of the article, again, graded by outstanding quality and multiple growth drivers, but premium valuation. I'm not going to read this article word for word for you. If you have a Seeking Alpha subscription, be sure to check it out. I'll link in the description as well. And if you would like a subscription so you actually can read the entirety of the article, I have the ability for my followers to do so at roughly a 10% discount. So I'll be sure to include that link as well. But the main thing I want to cover here is how we've done in that time. Here, total return of 6.25% versus 17.5% decline in the S&P. Not necessarily expected. The Liberation Day tariff volatility we've seen, not expected, I guess, at this time to the degree that we've seen. However, part of the thesis here, right here, despite a high valuation, RSG's consistent outperformance in bear markets in alignment with GARP style investment strategies justifies premium price. GARP, of course, meaning growth at a reasonable price for those that aren't familiar. So here's the deal with this company, and I'm going to reiterate it here. The point that I see of having this in a portfolio is that it has a pretty good level of growth, both historically and conceivably into the future. There's decent growth, near or slightly exceeding the stock market at large. Um, we're talking high single digits, between 5 and 8% revenue growth year after year after year is kind of what we're looking at for a company like this. That's in excess of inflation. They have a strong economic mode, which allows them to increase their profits faster than that. There's a degree of operating leverage there. Um, and so very, very attractive growth stock. In fact, that's kind of similar. That's similar growth, a similar growth profile to another company that I really like, Costco, which is notoriously expensive at all times. And I think that RSG kind of reminds me of Costco in that way, in that it's just very consistent, stable, very down the path and narrow stability with its growth. And the market has bid up the stock price as a result of that because there's a high perceived level of safety. Now, with this, one thing I want to discuss here is how tariffs, the disruption of tariffs, impact that potentially or not. Okay. But before I get into that, what I want to discuss, obviously, we've seen since December, we've seen a high degree of outperformance. If we back that up to a year, now with the recent drawdown in the S&P is actually negative over your time frame. And in fact, that's price return. Let's look at total return. So on a total return basis, we are 25%. We are outperforming by 25%. Now, that was there wasn't really any difference between the two companies really until right around the Trump inauguration, until January of this year, and then we see a pretty notable divergence. Now, obviously, the two prices are correlated. Okay, this isn't a stock that's inversely correlated to the index. That's not where the outperformance is coming from. Where the outperformance appears to be coming from is that it's not selling off as much on down days over a long period of time on average. Visually, we can see that here. I've done this many times on the channel, by the way. So if you're new to my channel, I do this method quite often. I think I came up with a term for it. It's visual charting, visual analysis, visual correlation analysis. February 19th was the day that the index really started its current drawdown. RSG did not draw down. RSG did not start drawing down until about 2 weeks later. And then it saw a dip here. A dip in line with the market. So, of course, you see the magnitude of this move roughly the same. But the fact that RSG traded up over this time frame, roughly 5% up, makes a world of difference in the long-term performance. And then again, here, while the S&P kind of fumbled its way down slightly, RSG continued up. And then pretty similar move the last few days, though, with a broad sell-off. In fact, we see that here, that it's actually underperformed over 5 days. Now, again, the S&P popped a lot this morning. So that gives you an idea of the difference in performance there. And then this, I believe here, this does appear to capture the after hours trade here, because that appears to be a cumulative effect of after hours plus this here. So a slight amount of outperformance there in the 1 day. Now here, again, year to date, the S&P being down 15.25%, RSG still up 13%. Part of our thesis here is it's consistent outperformance in a bear market, otherwise referred to as a defensive value strategy. So has that held up? Absolutely. Absolutely. Now, what else is going on? The stock, because it's up since we last covered it, and the earnings really, the financial performance hasn't really changed meaningfully. It's, I believe, even more expensive today than it was then. So here's the deal. When you have indiscriminate selling across the board, your most defensive positions, they're still selling off. Maybe they're green on a particular day, but if the S&P is tumbling by 50%, like this humongous drawdown, right? Your defensive stock isn't inversely correlated to that unless it's highly correlated with some sort of commodity that's like going bananas up, right? It's likely that your asset is selling off as well. I'm realizing that I need to be using this terminology more, because I saw a gentleman on MSNBC, I believe, a fixed income manager, and he described himself as an absolute return manager, not a relative return. And what absolute return means, strong returns in every environment. so the benchmark is you kind of have a dual benchmark there. You have the benchmark of the index benchmark you're tracking, and always having positive returns. I don't focus on that. Of course, I want to have positive returns in every environment, but I am a relative benchmark investor, meaning that I am trying to outperform the index. Okay. And my steady state belief is that over a long enough time frame, if my focus is outperforming in a bear market, like if I care more about outperforming in a bear market than over a long period of time, I will outperform the index. So, despite the fact that this company does appear to be very expensive, I think that it foots the bill. It foots the bill. Now, why is the stock outperforming so much? In the short term, prices are driven by the supply and demand for shares, right? And though the supply and demand for those shares is correlated to the underlying business performance of those shares, in theory, the less, I think, notable or visible a stock is, the more correlated it is. Whereas you see some of these names trading at wildly speculative valuations. They might just be hot stock names, and they're more correlated to, the supply and demand for those shares is less correlated to the underlying business performance. Anyways, that's a tangent. What I'm trying to say is that I want to go back to our deck here. This is the same deck we looked at last time, but the thing I want to highlight here is this: essential services. They pick up trash, they recycle. Essential services, waste collection and recycling is occurring in good times and bad. Now, of course, even in a recession, the volume of that might be impacted, but I think that that's probably more impactful on the industrial and on the industrial services that a company like this has, like renting out dumpsters and stuff, versus residential pickup, which is happening at all times, right? So, anyways, goes without saying that the strong and predictable free cash flow, or 80% of revenue carrying an annuity type profile, is very, very recession resistant. And when things are looking a little spooky in the market, investors are going to gravitate, or more likely to gravitate, towards Republic services, towards an annuity type cash flow profile, right? Because bonds are an annuity type profile. And this business happens to have a very cash generative model, and therefore the supply goes down and the demand for shares goes up. Okay. But of course, when asset correlations are converging to one in an indiscriminate selling environment, you're going to sell off on that particular day. So the day of the day that tariffs were announced, April 3rd, Republic Services traded up. It was like up 1.5, 2 points. Okay. The market sold off almost 5 points that day. I was like, crushing it, right? Crushing it. Well, of course, the next day, nothing was safe. Fear came. You see, it also sold off quite a bit on that day. So that gives you an idea of just how over 2 days a company can outperform. We see here that's a roughly 2-to-1 level of outperformance. We had 130 basis points up on Liberation Day, whereas the S&P 500 sold off by 5%. And then we converged to more correlation. So what's going on there? Rotation, right? Rotation. That is, I don't want to say bullish, because the last 2 days we've sold off, but that's evidence that our thesis might be correct about the defensive posture of the business. Absolutely, looking at this performance, even though I'm looking at the valuation of the company, and it makes me want to puke, because it's very expensive. Okay. And it's the yield, the dividend yield, and the free cash flow yield are so low they're so low that you can't, it's not one of those things that you look at and you say, this is a good value, right? Where more when you're looking for where to hide in a bear market and you want to keep taking equity risk, that increases the demand for defensive names like this. Okay, so that's the idea. Well, demand has been increasing for quite some time. And again, we highlighted this prior, where you could have picked up shares for close to a 3% yield 10 years ago, and now it's 1%. Um, and the valuation on a yield basis much more expensive than 5-year averages. You look at that and you're like, oh, I don't know if I can stomach that high of a valuation, and that would be objectively a pretty smart view. However, I do believe that the company continues to outperform. It doesn't mean that it won't go down, right? It doesn't mean that it won't go down with the broader market, but I do believe that it will continue to outperform. Okay. So now let's talk about tariffs. So again, it's defensive, but what about my tariffs? Well, this is everything you need to know about tariff risk. I can count. This looks weird. What happened to the coast? Isn't this supposed to be an island? Fix your map. Is that really what it looks like? I'm not going to look, the idea is out of hundreds of facilities, several hundreds of facilities, they have less than 10 in Canada, and the remainder are within the United States. So the revenue profile of the business is not directly impacted by a tariff. They don't have to upcharge their service because of a tariff immediately. They don't have to immediately reprice their service. Okay. Now, the costs of their trucks and their equipment and stuff like that are immediately impacted, potentially. Uh, and of course, if tariffs create a recession, then that might create a tepid demand environment in the economy, which might impact volumes. However, the relative impact of tariffs on this business versus one that's moving goods across this border and from Asia and from Europe, significantly different. So not only before tariffs did we have a relatively stable cash generative model, but after tariffs we still arguably are in the top decile, top 5%, maybe even the top 1% of all American businesses when it comes to our insulation from that tariff disruption. So you tell me, again, this is not financial advice. Okay. I'm not recommending that you buy this. Okay. But it does make you wonder that for investment managers that need to deploy capital, does the demand for shares stay higher than the demand for other shares? And I would argue that it does. So again, we gave it a buy. I'm going to keep it at a buy. Again, being a relative benchmark investor, my performance is relative to the benchmark. Therefore, I will keep this as a buy. I expect it to continue to outperform. Now, in terms of how does the chart look? I mean, I think in terms of the chart, slow and steady, very rough. One thing I've considered is that I didn't even realize until recently that you can actually submit works to TradingView. And I haven't saved like any of these charts. There's screenshots of them on my articles, so they're enshrined in that way. But I haven't really saved these charts. So I'm working on remedying that in the go forward. So let's take a look at the chart. uptrend is still confirmed here, right? We know what happened here. This is bear market. Last bear market. The stock didn't really go down. It just kind of went sideways. That's sideways. That's flat. It was flat. Now it's been going up. Okay. Now it bounced off of the trend line, the upper trend line resistance. Still well within the channel. Is it conceivable to think that it can trade down all the way to the trend line? Absolutely. Is it conceivable to think that it will break out of this trend line? Absolutely. Okay. But here's what might happen to a really strong defensive stock in a broader market-based bear market. You see what happened here. Here was our uptrend, right? Hopefully what I'm saying is making sense. Here's our kind of uptrend, a little bit more climactic there as a convergence. But what happens in a bear market? You break down out of your trend line, okay? But then you find the base you had before. You see here, we had our base here, right? And it just consolidated there. So what would that look like? It might look something like this. So in other words, let's say that you continue to have this market weakness for the next, several weeks, and there's a reversal there. That might coincide with this line here. In which case, confirmed, then this is your next level to beat, right? But let's say we break down below that. Well, here's what I would expect as more likely than just for it to tank. If you can find a time that occurred, it would be here. Okay, now we're talking. See, now this is where we're getting to the meat and the bones of it. Okay? I'll come back to that in a moment. But if you have, in other words, what I'm saying is, if now there's a lot of recession, like big recession talk floating around. The tariff disruption is an extremely disruptive event to forward expectations. Okay. I don't think, based on what I can assess, I do not believe that tariffs will materially impact the cash flow of this company. Okay. I do believe that they will impact the stock price if nothing changes. I think that it will impact it to a lesser degree than other stocks, and particularly the market at large. Okay. So that's what I meant earlier by saying I wouldn't say it's bullish, but it's a relative beast in my view. Okay. So if we have the kind of panic that we have here, although the economy here there was no recession that happened here. There technically was no recession here. There was an inflation scare. If this is a tariff scare, I would expect sideways trading, maybe even for several years, while the business continues to modestly grow. I can feel pretty good about continuing to accumulate shares. If we're going to break down here, well, you're probably still better off in this name than others. Okay. But let's take a look at what that looked like in 2008. Okay. Let's take a look. Crude chart, but you get the idea. Okay. What ended up happening here was a little bit more volatile because, again, we didn't really break into a consolidation like here because the global financial crisis a lot more disruptive, but also very short-lived. It took 5-ish years to get back to the original price. Here, there's a lot of fear. The soft landing is real. I think what inflation did was it caused a lot of angst amongst our population and is leading to some of the issues that we have today. But in terms of the actual economy, the economy here, some might argue with me that it's all fake and propped up by government spending. Whatever. I don't necessarily disagree with it maybe not being as strong as it could be, but certainly much stronger than other nations. We can't dispute that. And if you do dispute that, then I don't know what to tell you. But what we're seeing here is this is fear. This is a market-wide panic. This is a business kind of, returning. You would have doubled your money here buying the low. If you would have bought it here, you would have only need to hold it for two years to be back to even with this huge drop. So I said I expect it to trade sideways, and that's because while I do believe that the tariffs are widely disruptive and threaten to severely disrupt trade internationally, I also believe that this business is the underlying business will do just fine throughout all of that. In fact, taking a look at that, you could have easily drawn the conclusion. Here's the .com. I mean, just look at that volatility. We had 30% volatility here. The business has appeared to achieve a more balanced level of volatility over time. We might be able to assess that. Let me just pull up something in my other screen here just to see if we can verify that. But while that's loading, I'm going to show you something. We're going to look at the revenue of the business. So here's the revenue. Yeah, I don't have the Pro Plan of Portfolios lab anymore, so I can't look at the 30 years ago volatility compared to today. But for the sake of time, what I want to highlight is this. This is the revenue chart. We can get rid of that. Oh God, I don't know why it keeps doing this. Income statement, revenue. Okay, so this is the revenue going back 30 years. I'll tell you what I notice. There's a few periods here where it dips. I mean, here it didn't dip at all. Here, obviously, it grew a lot, but there was a merger that occurred here. What Alliance? Is that what it is? Republic Allied. June 2008. Following the acquisition of its larger competitor, Allied Waste. So we saw here that accreted that value. So while it's unclear if there was apples to apples, some sort of revenue decline, of course, they didn't print that because they performed an acquisition at the bottom of the market. In fact, 6.1 billion in stock. Maybe that has something to do. Oh, how incredible is that? I wonder when they announced that the merger. But here's what's interesting: is they bought the company in a pure stock transaction, and then the stock tanked by more than 50%. But obviously, this is what the stock looked like. This is what the revenue looked like. Wow, pretty incredible, right? You could have had this business for 8 billion of revenue at the same price that it was at for 3 billion. Okay, at the same price. Okay, so that gives you an idea of what the valuation might have been at this time. But the point, I'm getting off topic. The point I'm trying to make is this isn't a very granular chart, but you do see here there was a slight revenue dip. Here. This company has incredibly stable revenue. And whether that be a tariff induced recession or tariffs themselves, I believe that the relative stability of those cash flows will hold. Chart looks really good. All right. We've sold off. We could sell all the way back down to 200. That's a greater than 10% here. Okay. But I believe that if that were to occur, it's because the S&P is falling another 15 to 20%. So you're still relatively outperforming. So while I don't necessarily think that picking up a stock at today's prices will immediately translate to gains 2 months from now, it might, but I don't know that. In fact, I think the likelihood might be lower that we continue to dip. Nobody knows the future. I think the key here is that during an event like this, you want to pick up the names that you believe in, that you think are safe, stable, and relatively will outperform. I believe that this is one. Now, one thing I want to highlight, we've done very minimal financial analysis here. They did very well in their most recent earnings report. Revenue missed, but up almost 6%. They had a very, very large earnings beat. So earnings per share up 12% year over year, marking at least 4 consecutive quarters of double-digit earnings per share growth. Earnings per share is expected to moderate somewhat to 6.64% in the coming quarter. However, you know, still pretty good. So the consensus is that earnings will come in a little lower than the prior quarter. You see here though this orange line being our EPS growth year over year. It is moderating somewhat down into the mid or low single digits. I don't see any cause for concern there. Again, very expensive stock. There's plenty of tantalizing value opportunities in the market today that might be better than this. However, I do firmly believe that if your stated purpose here is to acquire a stock in today's volatile market, you're looking for better risk adjusted returns and for relative outperformance, that this will continue to do that for you. But look, things are crazy out there, folks. Okay, things are crazy out there, folks. I made a video about my thoughts on tariffs. Okay, I'm gonna let tomorrow happen before I comment on that further. Okay, but stay safe out there. Okay, I wouldn't be too eager to deploy a bunch of capital right now. But that being said, if you have a long enough time horizon here, I wouldn't be too fearful of it either. I would prioritize deploying capital into more defensive positions, which I've been doing for the last several years. So, anyways, that'll conclude the video today. Hopefully, my perspective here is making sense and is good. I would just I might circle back to this here. The earnings report is going to be on the 24th, so 2.5 weeks from now. So I might be a little early with this video. Maybe I'll revisit it at that time. We have a big earnings season coming up, especially with all the tariff nonsense that's been going on. And this one's on the docket for that. But wanted to just jump ahead of earnings here and discuss how we're doing in light of the last few days with this particular. And honestly, I have a few more videos that I'm going to make here in short order. So anyways, hopefully you found this helpful and entertaining and instructive. And comment, let me know how I'm doing. I would love to interact with you. I appreciate all my viewers, my subscribers. We're a very small channel. So all the, I enjoy doing this and look forward to continue serving you, my audience. I see that I've gained a few subscribers in the last few weeks. So really appreciative to all who have subscribed and look forward to continuing to deliver this for you. So anyways, hopefully you found this useful, and I will talk to you soon. All right, see you.